Welcome to today's video, where we're taking a deep dive into a real subscriber's portfolio. George T. reached out and shared his investment details with us, and we're excited to walk you through his portfolio review. This analysis is prepared specifically for George and is intended for educational purposes only. Let's set the stage. George is 45 years old, based in Missouri, and looking ahead to retirement at age 60. His main focus right now is building long-term wealth and preparing for a secure retirement. He's also thinking about the impact of inflation and wants to make sure his investments are aligned with ESG, environmental, social, and governance principles. George describes his risk tolerance as moderate, and he's investing with a long-time horizon in mind. His portfolio is well diversified, spanning U.S. stocks, ETFs, international and ESG funds, bonds, real estate, and a small cash position. In this review, we'll highlight the strengths of George's approach, identify areas for improvement, and share actionable recommendations he and you can use to build a stronger financial future. So, whether you're just starting out or looking to optimize your own investments, stay tuned as we break down George's portfolio and discuss strategies that can help any investor reach their goals. Let's get started. Let's start with the strengths in George's portfolio. He's built a solid foundation with high-quality U.S. growth stocks like Microsoft, Apple, and Amazon. These companies are industry leaders, showing strong growth and profitability, and have delivered consistent returns over the past decade. Microsoft stands out with its leadership in cloud computing and AI, an A+ growth and profitability grade, and a dividend that's grown for over 20 years. Amazon's cloud business continues to drive profits, and its retail segment is rebounding. Apple remains a core holding with a strong brand, recurring revenue from services, and a history of innovation. George's use of ITOT as a core ETF gives him broad exposure to the entire U.S. stock market, which is a smart way to capture overall market growth while reducing the risk of betting on any single company. AVSD and DFSI are top-rated ESG and international ETFs, providing diversification beyond U.S. borders and aligning with George's interest in sustainable investing. These funds include global leaders like Novo Nordisk, HSBC, Novartis, and Roche, which aren't heavily represented in U.S. tech-heavy ETFs. NXST stands out among his dividend stocks, offering a rare combination of high yield and consistent dividend growth. His allocation to TIPS funds like VIPX and BFIAX shows he's thinking ahead about inflation protection, and real estate exposure through VNQ adds another layer of diversification. However, there are areas where George can improve. The biggest concern is concentration risk. Microsoft, Apple, and Amazon together make up a large chunk of his portfolio. And when you factor in their presence in ITOT, EGUS, and CHGX, his real exposure to these names is even higher. Palantir is another risk. While it's performed well recently, it's highly volatile and speculative, which doesn't fit a moderate risk profile. Ben and SMG are weaker links in his dividend lineup, with inconsistent growth and lower safety scores. VNQ's recent performance has lagged, and it's worth monitoring as real estate markets shift. There's also significant overlap among the ETFs. ITOT, EGUS, and CHGX all hold the same top tech names, so George isn't as diversified as it looks on paper. AVSD and DFSI help by adding international exposure, but the core of the portfolio is still very U.S. tech-heavy. The dividend stocks, NXST, BN, SMG, are more unique and not heavily overlapped in the ETFs, but only NXST really stands out for quality and growth. Given George's age and time horizon, his focus should be on growth and compounding now, not on high current income. The dividend yield is nice, but reinvesting those dividends will do more for him over the next 15 years than taking the cash. As he gets closer to retirement, say around age 58, he can start shifting more into income-generating assets and bonds for stability. To strengthen his portfolio and better align with his goals, here's what I recommend George adds. To reduce concentration in U.S. mega-cap tech, George should consider adding Schwab U.S. Large Cap Growth ETF, SCHG, or Invesco, S&P 500 GARP ETF, SPGP. These funds offer diversified growth exposure but aren't as heavily weighted toward the same few tech giants. If he wants to keep some tech focus, Invesco QQM is an option, but he should be mindful of overlap with his current holdings. For international and ESG diversification, George should increase his allocations to ABSD and DFSI and consider adding Vanguard ESG US Stock ETF, ESGV, or iShares ESG Aware MSCI USA ETF, ESGU. These are low-cost, broad-based funds that align with his values and help balance U.S. exposure. To tap into faster-growing regions, a small allocation to an emerging markets ETF like Vanguard FTSE Emerging Markets, VWO, would add another layer of diversification. On the dividend side, George should gradually reduce his positions in VEN and SMG and reallocate to dividend growth ETFs like Vanguard Dividend Appreciation, VIG, and iShares Core Dividend Growth, DGRO. These funds focus on companies with a strong track record of increasing dividends, which is better for long-term compounding than simply chasing high yields. For inflation protection and sector diversification, George should keep his TIPS funds but consider adding a broad commodity ETF like Invesco DB Commodity Index Tracking Fund, DBC, or an energy ETF like Vanguard Energy VDE or SPDR S&P Oil and Gas Exploration and Production, ETF XOP. These provide a hedge against inflation and reduce reliance on any one sector, adding exposure to defensive sectors through consumer staples. Select Sector SPDR, XLP, and Healthcare Select Sector. SPDR XLV can also help smooth returns during market volatility. Rebalancing is key. George should review and rebalance his portfolio at least once a year to keep growth, dividend, and defensive allocations in line with his goals. He should also check for overlap using tools like Morningstar's Portfolio X-Ray to make sure he's not too concentrated in the big tech names. In summary, George's portfolio has a lot of strengths. Great growth names, solid core ETFs, and smart inflation protection. But he needs to watch out for overexposure to U.S. tech and underperforming dividend stocks. By trimming back on concentrated positions, boosting international and ESG diversification, and focusing on dividend growth rather than high yield, he can set himself up for stronger long-term returns and a smoother path to retirement. As he gets closer to 60, he can gradually shift more into income and stability, but for now, growth and compounding should be the main focus. If you want a detailed review like this for your own portfolio, check out our Substack. We offer personalized portfolio breakdowns, actionable ETF and stock ideas, and ongoing education to help you reach your financial goals. Don't guess with your money. Get a real analysis and a plan that works for you. Join our community and let's build your wealth together.